Okay, good morning, everybody. It looks like it is right at 10 o'clock Central, so I think we'll go ahead and get started with our option two of the September 2025 WPS Medicare Audit Provider Webinar. So today, as you can see here, we're gonna, as you can see in the next couple slides, we're gonna talk about a variety of different topics. But before we get to that agenda, I wanted to just go through a few housekeeping items, just normal things. First of all, I am recording the session. We'll be posting it to our YouTube channel, just as we have in the past, and we'll be sending that link, a copy of the PowerPoints, an attendance certificate, CET, CPE, whatever you want to refer to it as, and another copy of the agenda to all attendees just a few days after the meeting. Now, last time the WebEx system made a little bit of a change and it caused us some trouble. We found that right around half of the attendees apparently didn't sign in with an email address, and some of them even just used initials, not a full name. But even without the email address, I had no way of sending out the certificates to those people that didn't sign in. Now, what I've done since then, I've changed the way we do it, and you're all here, so you all are aware of this. Now we require the registration, and that'll force you to put in your email address and your name, and then it'll actually give you the link that you need to access to attend the session. So now, if this works as it should, I should be able to generate a roster like I did in the past and quickly send those items out to everybody. Now, I did also, in the email that I sent yesterday, I sent the registration links again, but I also sent just a clean attendance link. So if you did not register and you just went to that attendance link, then we might be in the same boat that we were last time where I don't have your email address. So if you happen to have done that and you didn't register and you just attended and you need a certificate, I'll need you to send me an email after the session. But again, if you did register, you should be fine. And sometime by Monday, you should have your information here. Now, the other thing is for those attendees that are not from a MAC, in other words, if you're from a home office, provider, consulting firm, whatever, if you could take a few minutes at the end of the session or during the session if you want and complete a survey, we would certainly appreciate it to get some feedback on what options you'd like to see, what topics, anything we can do to improve. So I did include the link to the survey in the email. I'm also going to post to the chat area right now, and I'll also send it out in the follow-up email as well. So if you could take a few minutes, again, if you're not from a Mac, if you could take a few minutes, that would be great. I would appreciate that. Here is the link for today, and there's also a QR code for those of you that like to use your phone, turn the camera on, aim it toward that picture, and it basically takes you to a link for the survey as well. So either way works. Thank you very much. Now on to our agenda. So every session, we start off with a little refresher of the S10 uncompensated care audits, just because it's something that's going on pretty much throughout the year. Now, in February, we have our S10 section heading into the last quarter. So there's not a whole lot, there's nothing really new. It's more of just a refresher. I kept the slides in here, but I am going to be going through some of them pretty quickly because we have plenty of other topics that are new that we want to focus on. So the information's still there. I'll refresh on a few things, but it'll be pretty quick. The other topics, some of these are new, some of them are continuations of other topics. We have dish issues. Here we're focusing not so much on the projects that we've talked about in the past, but Medicaid day counting, some rules related to that, and the documentation requirements. We will talk just briefly, a reminder about the SSI realignments, and those are basically the different things related to dish. Now, RHC consolidation and really base rate, I guess I should put in there as well. These issues we talked about in quite a bit of depth last quarter. I brought them in again because we do have a new clarification from CMS that adds another piece of information to the whole mix. So for this one, I've brought in most of the same slides from last time, but I've also embedded the clarification, the information, so it'll help give us the better picture of it. So we are going to talk about that quite a bit. It's a really convoluted topic. We're going to talk very briefly about the federal fiscal year 2026 IPPS final rule update. And that was issued in August. And of course, it's becoming effective in a week, 10/1, for those, all the rate changes, all the rule changes. We'll spend a fair amount of time talking on Medicare and total bad debt issues, total being for S10, but of course, just Medicare in general. And then we'll spend a little bit of time refreshing on a topic we haven't talked about for a while, nursing and allied health managed care add-on calculation. And then we'll wrap up just with an overview of the resources that are available. Now, regarding questions, I do want to remind everybody, if you do have questions throughout the session, feel free to use the chat area and send those in. I've got that on my other monitor, so I'll keep an eye on that. And that way we can address those questions while we're in that topic. There'll be time at the end, of course, if you have any final questions, but feel free to send them in along the way as well. And I'm using the app version of WebEx today instead of the browser because the browser seems to cause trouble. It caused quite a bit of trouble yesterday. It locked down the chat area, at least for me, pretty early on in the session. So I'm hoping the app version will work better. But again, feel free to type those questions in. So with that, let's move on to our first topic, which again is going to be the S10 uncompensated care audits that were the federal fiscal year 2023 data. So these cost report periods beginning 10/1/22 to 9/30/2023. Now, this whole 3-year average, again, that'll come into play with that uncompensated care payment later. But we expect, based on the past few years, that this data will be used as one of the 3 years of average data for the factor 3 calculation starting 10/1/26 next year. These aren't going to be done until 12/31 of this year. CMS needs time to analyze that data. So we know what we're auditing, and every year it just rolls forward by a year. And it's currently all DISH eligible hospitals. And for that definition, we're saying they report DISH on E-Part A line 34. We've already talked in the past about how that currently includes all sole community hospitals. Whether or not CMS will change that, who knows? We've talked about the reason for that, and again, we'll see if that changes later on. The key reminder here is that if a provider doesn't start with DISH, but then amends that cost report later to have DISH, we do need to come back and do an S10 audit at that point, even if it's after 12/31 of the year. So we would work with CMS on that. And, again, the biggest thing this year, we talked about this very heavily in February and even last quarter in June, but this is the first year of a fairly major set of changes in the cost reporting instructions. We talked about how they have the new templates that came into play for cost report submission. The key thing here is if we are going to audit this, if it's a hospital that has reported DISH on their cost report, we do need the templates. Now, we talked about some things that have evolved throughout the year about what template we can allow. And, we came to that compromise. We worked with CMS where we could allow either of the templates as long as they had transaction code. So we don't need to rehash that anymore, but we're waiting to see. We haven't heard anything from CMS on revising either the audit program or the templates for this next year. And it's obviously a little late anyways for anything to affect the next year's set of audits because a lot of those cost reports are already certainly started, and some of the fiscal years have even been submitted or very close to being submitted. So we'll see what happens in the next few months. We'll keep you informed. Now, there was the question about, do critical access hospitals have to fill out worksheet S-10? We said technically yes, but it's not used for anything at this point, and it's certainly not part of the S-10 audit. So we hope CMS will change that, but right now that's the answer we have. And again, just a refresher on the two exhibits. Exhibit 3B is the charity care listing. 3C is the total bad debt listing. For cost report submission purposes, these are required for cost report periods beginning on or after 10/1/22. And until CMS changes that, you'll have to continue to submit that. Again, though, there's a question of whether or not you need to submit it at the time of cost report submission, or can you just wait until the S-10 audit? And in this situation, that's where the SCH comes into play. If you are SCH and you have a higher hospital-specific payment, technically you don't need to submit this at the time of cost report submission, but again, we're still going to need it at the time of audit anyways. So it's just one of those odd contradictions in the instructions. Not so much contradiction, just inconsistency. I guess that's a better term. We talked about how this is all based on DISH reporting, DISH eligibility, if you will. And if you are DISH eligible, this started way back in the August 17th, 2018 cost or Federal Register. This is where they put in the cost report rejection requirements for, well, there weren't any specific templates at the time, but they basically said you have to send in documentation that ties to the cost report amount. The templates didn't come into play until a few years later, obviously, but this has been there since 2018. So if you do have DISH, the cost report would be rejected if you don't have that detailed listing of charity care. Now, that's the odd thing. They didn't include total bad debts, the other listing. So there's nothing in regulation allowing us to reject it. But of course, we do need it at a minimum by the S-10 audit time. So we're not going to spend a whole lot of time on this. We've covered it in a few sessions, but this is another one of the major changes that CMS made this year. They have the whole line 25, S-10 line 25 mechanism that they used for those partially covered claims where part of the claim was not covered because they exceeded the length of stay limit for Medicaid. So that non-covered portion, the charges related to it would go into line 25 as well as line 20 column 2. Line 25 was the way the system knows how much of line 20 column 2 was a charge figure versus a co-insurance and deductible. So that's been in place since the beginning of our S-10 audits. Line 25, they added line 25.01. They kind of doubled down on this whole mechanism, and now they're using it for all other situations where it's a partially covered claim. And I actually shouldn't even say partially. It could even be a fully non-covered claim if they were indeed insured. They just weren't covered for that claim for whatever reason. So line 25 is just for the Medicaid length of stay, exceeding the Medicaid length of stay. Line 25.01, it's the same mechanism, but it's for all other insured patients that are not covered for part or all of that claim. And again, anything you put on line 25 or 25.01, by definition or by mechanism, if you will, it's a charge figure. That's the only thing that should go in these two lines. But that same charge figure must also be in line 20 column 2, commingled with the coinsurance and deductibles that are normally in line 20 column 2. So again, I'm not a fan of this mechanism at all. There's a much better way to do it, in my opinion, but we have to live with what there is. So so line 25.01, it's actually for any of the cost reports that began 10/1/22 or after. So really, you would have already filed a cost report that had line 25.01 But yeah, you'll definitely need it for the ones due in November as well. So it's basically 1 year old, if you will. It's a 1 year old kind of requirement so far. Now you may not have it, you may not need it if you don't have any insured claims that are non-covered for part of that stay for whatever reason. I mean, it could be so basically it's every non-coverage issue except for the Medicaid length of stay limit. It could be that Medicaid just didn't cover that type of service. It could be that the insurer didn't cover that type of service, but it was otherwise allowable. Exhausted benefits for other reasons other than Medicaid, those could cause non-coverage. So any of those types of things. It's again, the end result, it it impacts line 30 the exact same way as if we just took a claim and split out the covered and non-covered portions and put the covered portion in column 2 insured and the non-covered portion in column 1 uninsured. It ends up being the same overall result, but CMS made it clear they want us to use this mechanism instead because supposedly they are using either they or Medicaid, the Medicaid agencies, they need this data separated out. They need to know why or what portion of a claim was non-covered for one of these reasons. That was the answer we were given, so that's all we really have to go off of. That's the answer given us to why they can't just simply split the claim across column 1 and column 2, like I would certainly prefer. So hopefully that helps to clarify there. It's one of the more convoluted pieces we have, and this is just support for what we've talked about with that. The other unfortunate or convoluted thing they added to the template, the new template. Now, again, whether you would have had to submit that with the cost report, you may or may not have used this for your S10 audit, but regardless, there's this column 6 that has these insurance status codes 1, 2, or 3, and the instructions just are not clear on on certain situations where they would fall. Last couple of webinars, we gave our best explanation of what we think CMS want or where we think CMS wants us to use these codes, and that's all summarized down here. But it is definitely not 100% guaranteed or clear. This really needs to be clarified in the instructions. Now, even though it's too late for the template to be updated for even this next year's audits, we hope we can get CMS to at least clarify this better, clarify the instructions. But what I want to stress here, what code you use, if you happen to use the wrong code, it's not the worst thing in the world because, again, it's already inconsistent. The big thing is that the auditor understands what that type of claim was. So as long as you explain to them how you classified certain types of claims, that gives them the information they need to properly scope and stratify the sample. And the whole idea is these different groups of claims need different testing and they might need different stratification. So as long as the auditor understands how you did it for that cost report, even if another provider did it a different way for the same scenario, as long as the auditor understands your intent, we can work with that until these get clarified. So hopefully down the road, we'll see that in the near future. Of course, this year wraps up December 31st. And next year, we start pretty early. You know, we have our webinar in February. We sent the letters out a little bit before that. We're going to actually try to send them out even earlier next year just to give you longer to gather your data. Now, we can always work with extensions anyways, whatever due date we give you in the initial letter. If you need an extension for some reason, we have no problem with that. The whole idea is just getting things identified, getting the letters out to the providers so they can at least start gathering it, start asking questions. And then, of course, we'll have our webinar. So you basically you'll expect these letters to come out to you earlier, but the hope is that we can give you a longer time frame to respond with that for that reason. But also, we're going to try to do some different ways of pre-assigning auditors to these to the providers, because I know one of the issues we've had is that we send the letter out and we put a little blurb in there that wait to be responded or wait to be contacted by your auditor so that they can connect with you on the secure file exchange portal. And I know that's caused confusion. So we're going to try to somehow pre-assign auditors or at least coordinators to reach out to you. And that way, whenever you're ready, if you happen to be ready a week after you get the letter, you'll be able to start the ball rolling and submit that. So we're going to try to do a better job with that this coming year. More information to come on that. And again, we don't know if CMS is going to revise the audit program or the templates. It's too late for the templates anyways for next year, but hopefully more to come on that. And I thought I saw, I did see a question here. Let's see. No, so do we anticipate any significant changes in the request? Not at this point. We haven't heard that CMS wants to do anything different. So it should be the same as this year, only hopefully more consistent and kind of cleaner. That's our hope, but nothing as far as what the templates look like or what we're going to be requesting. We haven't heard anything about that. Oh, and I missed this other question. So line 25.01, should that use be somehow indicated in the financial assistance policy? And the answer to that is not so much the reference to line 25.01, but you definitely need to have something in your policy saying that you allow non-covered type items like that, whether it be Medicaid not covering it, whether it be exhausted benefits. So there definitely should be something in the policy saying what types of things you allow for your financial assistance policy. You don't necessarily need to reference where you report it, though. Just the fact that you allow it in general is all that's needed. So good question there. And just a little wrap up of S10, our information, the resources we have for S10 uncompensated care, the YouTube videos, the website, all of that. Okay, so I spent a little bit more time on S10 than I thought, but we should have plenty of time for the other items. So this first piece is DISH issues related to Medicaid day counting. This goes all the way back to the federal fiscal year 2010 final rule. And at that point, or I should say prior to that point, the only option for counting Medicaid days, well, first of all, they were on S-3 only at the time, where most of the days, discharges, beds, all of those are reported. But at that time, they were only on S-3. Those Medicaid days were used, of course, for the Medicaid ratio, which impacts DISH. But in the 2010 final rule, prior to that, though, the only method that could be used to count those days was based on the year they were discharged in. That's where the entire claim, all the days for that entire claim were reported. So for an example, if they were discharged January 1st, 2025, but let's just say it was a 40-day claim, and obviously most of those days were in 2024, under the old rule, the entire 40 days would have been reported in 2025, even though only one day really took place in 2025, being the discharge. So that was the date of discharge method. That is still required on worksheet S-3, but the other change that came about, it was actually a year after this final rule. It was when the 255210 form set came out. They moved those days to worksheet S-2. They're still on S-3 in total, but they're on S-2 broken out by Medicaid day type. And we'll see that in just a bit. But this final rule changed it so there are now 3 methods for counting Medicaid days. You could use the same date of discharge method you've been using all along, or you can reverse it and report all the days in whatever year the patient was first admitted. So if they were admitted December 31st of 2025, but most of the claim took place in 2026, under the date of admission method, you'd report all of those days in 2025. It's obviously the opposite of the discharge method. The other method you could use here is the census dates or dates of service, just splitting the claim across the year. Perhaps half of the days in the claim go in 2025, maybe the other half go in 2026, depending on what day or what year each day took place in. Now, these methods are allowed now. We have 3 methods. They've been allowed for quite a while, since 2010. But the reason, by the way, some of these topics are coming up in the webinar is because we've had a fair amount of questions in this past few months about some of these things, this one specifically. So the only requirement here is that you notify the MAC of the change, and it has to be 30 days prior to the beginning of the cost reporting period. There's not technically an approval required. The only way we could reject it is if you didn't do it timely. You didn't notify us timely. So there's no real approval. But again, since it has to be done prior to the beginning of the cost reporting period, that means you can't do anything in the middle of the year. You can't change midway through the year. So in the Federal Register, back then, there were some big concerns about how allowing these methods would potentially allow for duplication of days if people switch from one method to the next. For example, if you switch from the date of admission in one year and then all of a sudden use the date of discharge in the next year, it's easy to see how claims at the beginning or at the end of one year or the beginning of the next year could span into the next year and be double counted. You could do the same if you switch from admission to census or from census to discharge. The same risk exists. CMS made it abundantly clear in that Federal Register that that would not be allowable. There have to be adjustments to avoid double counting days. So if you started with either the admission or the census method and switched to anything else, there is very likely going to need to be an adjustment to carve out the days that you already counted. So for example, if the claim was admitted in one year, but there are some days in the next year and it was discharged in the next year, when we're looking at that second year listing, any discharge that year that was also admitted in the prior year, that entire claim has to be disallowed from the second year because you already included the entire claim in the first year. So we're going to see a little bit of that here in just a bit. So that's the rule. You can't duplicate the days, and that takes both provider understanding as well as auditor understanding and review. CMS did include a little quote in that Federal Register that they noted they would expect that a hospital would rarely decide to change the methodology, and that such changes generally prompted out of necessity, like the state Medicaid agency changes their own methodology. But they stopped short of saying that you have to prove why you're doing it and that it's justified. They didn't really say that. They just expected it should be pretty rare. But as long as we can eliminate the risk of double counting, whichever method you want to use is fine. So let's go to the worksheet S-2 versus S-3. So on S-2, this is the top screenshot, and there's actually line 22 above that. That's your normal DISH question. Do you qualify for DISH? But 23 asks what method you're using. Column 1, it's either 1, 2, or 3. What method are you using? 1 is date of admission, 2 is census days, 3 is date of discharge. This column 2 over here is yes or no. Have you switched from the prior year method? Because obviously if you switched, then there's risk. Of course, we can tell that or discharge if you use the discharge method. 24 and 25. Now again, the days are now reported in total on S-3 by discharge. There's no method allowed other than discharge on S-3. But here, these are the days that actually get used now for your Medicaid ratio calculation for DISH on E-Part A. and they have to be sorted out by these columns. You have your IPPS hospital, your rehab subunit or hospital, and again, that's S-2. So your listing needs to match this. And that is a rejectable item. If your listing does not correspond to what you've reported here, then it could potentially be rejected. Now again, S-3, here we have column 7, that's your Title 19. That's where the Medicaid days would be reported. Now later on, we'll see there's an edit. If you are using the discharge method up here, and we know you're going to be using the discharge method here on S-3, then there's an edit if the sum of these doesn't match column 7, because you're using the same method, they should match. But obviously, if you're using admit or census, they don't need to match. It'd be coincidental if they did. So that's S-3. And the key thing here, a question that's come up lately, is whether there's any way to change the method you're using on S-3. And unfortunately, there are no provisions anywhere, policy or regulation, that allow us to even consider a change in how you've counted Medicaid or total days. So we'll see in just a bit that the rule in S-3 for column 6 and column 7, Medicare and Medicaid, is that they must be reported by discharge, but it's very ambiguous. It just doesn't go into much detail about anything else, unfortunately. So here's the S-3 instructions. It talks about reporting the program days for PPS providers. Now, by the way, program, when they use that word, they're generally talking about Title 18, the Medicare program, although sometimes it's used when they're talking about Title 19, Medicaid. But in any case, it clearly says here that it must be reported in the cost report period of discharge. Although I do want to say, if it's a TEFRA provider, which I know we don't have all that many of those anymore, cancer and children's hospitals basically, they still need to report their days based on the default method, which is basically census. Unless there's clear instruction elsewhere, which there is for these PPS providers up here. Now the other thing, we're talking about the dish day template now. So Exhibit A or 3A, again, it's only required if you're reporting dish on E-Part A line 34. There is that little exception for if you are an SCH provider with a higher hospital specific payment, then you don't need to report, you don't need to include your dish Medicaid day template. But things can change. Here's the thing about that. If, let's say you didn't qualify for dish initially, so you didn't submit a template, you didn't report days on S-2, but then if the change in the SSI ratio, that pretty much happens every time we do a final settlement because the newer data is available, that change in SSI ratio might lead you to dish eligibility all of a sudden. It changes your status. So in that situation, we would then have to go back to you and request that template, request the days to report so we can adjust it. So I guess what I'm saying here is, even though you're not required to submit the listing, if you did not report dish at the time of cost report submission, if you know historically that you tend to all of a sudden qualify when the SSI ratio comes in, or if you know what the SSI ratio would be based on your own internal records and you know you will qualify for dish, we recommend you submitting that listing up front. Again, it's not a requirement. We can't reject for it. But if you know we're going to need it down the road, it'd be great if you could report the days and submit it up front. Let's see. Yeah, so there's, good question. CMS asked us to provide reconciliation for the S2 days, and we were off by Labor Days. Should we be including these on S-2? And let me go back here. I think I had the or part of the instructions. Maybe I didn't, but there are some. It basically, if I remember right, it goes in this other Medicaid days. I think somewhere it's in here. I think you need to go to the cost reporting instructions themselves, or no, I'm sorry, the template instructions, and it talks about where the labor and delivery days would be reported. And I'm pretty sure it's the other Medicaid days, but it's in the template instructions. I thought I had them in here, but I guess I don't have the full thing. So yeah, they should be included as well. Good question there. And let's see. So we were And we just said if you're a non-dish provider, you don't need to submit that Exhibit 3A. And there's some information in the 3A instructions themselves. So again, let's see if that SCH instruction, we talked about that. And also down here in the regulation itself, it makes it clear for hospitals claiming a dish payment, the detail listing is required to avoid rejection. So it's only for the hospitals that are actually claiming dish. And here's a summary of that. If there's no dish claimed, there's no detail listing required at acceptance. And also if there's dish claimed, but you have a higher hospital specific payment, no detail listing required at acceptance, but things can change by the time of final settlement. CMS even addressed the fact that, maybe your hospital specific payment, whether you reported it incorrectly or maybe something changed oddly, there's a chance that that might fall below the federal rate. Or perhaps you have more federal payments than you realize through the adjustments. So it's rare, but that itself can change as well. So in that situation, again, the Medicaid day listing would be required. Now here we're getting on to some of the edits that pop up from time to time. So if you report DISH on ePart A line 34, there's an edit if you did not report Medicaid eligible days. Now, this is a serious edit, which that word, I know it sounds like, hey, this has to be fixed. It's odd, the labels CMS has given to the edits. Level 1 is the one we absolutely have to fix to even be able to submit the cost report and to HICRIS it on the back end. So level 1 is the days as long as your SSI ratio was high enough. Again, it'd be very rare to have 0 Medicaid eligible days, but it's not unheard of. So that's when this edit would just not apply. It's saying if you have DISH, then you need to have the days reported on S-2, and S-3 Part 1, Column 7 would be greater than 0 as well. But again, doesn't necessarily always apply. The other edit that comes into play is if you did use the discharge method, then the days on S-3, Medicaid days on S-3, must match the Medicaid days on S-2. And again, that makes sense because they're both using the discharge method. And again, this only qualifies or only triggers if you qualify for DISH. Otherwise, it doesn't matter. And of course, if you do have, this goes back to the regulation, if you do have Medicaid days on S-2, there must be a listing supporting them. And that listing now has to be this Exhibit 3A. And if it doesn't reconcile within a small variance that's allowed, if it doesn't reconcile, that might be rejected right off the bat. That's the requirement from way back in 2018. So none of this is new, by the way. It's all been around for a few years, but just, we've had questions on it lately, so I wanted to refresh on it. And here's that excerpt from the final rule. Again, for hospitals claiming a dish payment, it'll be rejected for lack of supporting documentation. So now we're moving on, and I didn't address this in the agenda, but it's another important topic that we have. It's uncompensated care payment. They basically said 75% of the traditional dish payment is being carved out, put into a big pool, and all providers that initially qualified for dish could potentially qualify for a share of this uncompensated care payment pool. That's, by the way, this leads right into our S10 audits. Our S10 audits are solely done to make sure every factor 3, in other words, every provider's share of this uncompensated care payment, to make sure that's correct, basically. So everything we do during the S10 audit leads to this factor, this line 35.01 factor 3. Now, if you don't qualify for DISH, let me back up. So if you don't qualify for DISH in a current year, by the way, this is E Part A, lines 30 through 34. These are the traditional DISH payment. Your SSI ratio, Medicaid ratio, here's your DISH patient or your DISH payment percentage, and then the ultimate DISH adjustment, the payment. Now, if you do not qualify for DISH, that would be 0, of course, and you're not going to qualify for the uncompensated care payment that year either. You have to qualify for traditional DISH to qualify for that. Now, the other thing, though, the way CMS has this in the cost report, it's a little bit convoluted. There's a lot of stuff done behind the scenes. So, and this is something that we've had questions on both externally and internally in the past few weeks, month or so. So I wanted to bring it up again. The way the cost reporting instructions work, if you've already qualified for DISH, and CMS knew you were going to qualify for DISH, and you've been around for a few years, then you're already going to have the calculation that HFS knows about. It's already on the table, which, by the way, we'll look at in just a minute, but it's already on the uncompensated care payment table, and it's built into the system. So it'll pull in line 35.02, which is the final payment amount. It does this calculation behind the scenes, and based on the cost reporting instructions, in that situation, it expects these to be 0 or blank. It'll pull in this amount by itself. So technically, the only time we should be reporting line 35 or 35.01 is if you are a new hospital and your payment is not on the table from CMS, which again, I'm going to show in just a minute. So that's what I wanted to stress here. First of all, if you are new, which in this case, the provider apparently is, then you need to report these numbers in order to calculate a line 35.02. Now, this is done at final settlement, but you could potentially do it when you submit the cost report if you know what those numbers are. Now, this line 35.02, keep in mind the uncompensated care payment is a federal fiscal year based payment. So if your cost reporting period spans 10-1, you're going to need 2 columns to report it. Line 35.03 is the portion of the of this payment right here. This was for the entire federal fiscal year, and this is prorated to match the number of days in this cost reporting period that fell in that fiscal year. So a small percentage of them fell in this year, but a larger percentage of them fell in this year. And of course, it sums them up. So now we're going to get to the template here. Oh yeah, we have a good question here. So Kim has a question about whether I'm talking about a new hospital or a newly DISH qualifying hospital. So for this, we're talking about a new hospital that hasn't even had any data. So specifically, they haven't had a cost report. Now, whether or not, let me back up. So it's whether they had a cost report in existence in the 3 years or in any of the 3 years that were used for this DISH uncompensated care payment, which that part will make a little bit more sense in a bit. But if they're brand new and they didn't have those, at least one of those 3 years a few years ago, so they're too new basically, and they're not on the table, that's what I'm talking about here. It's not so much newly DISH qualifying, it's just were they in existence at all. And this relates to whether there's anything for us, whether there's a cost report for us to pull an S10 line 30 amount from. But I do want to stress here, you could still be an existing hospital and maybe you just have not had anything on S10 line 30. That doesn't make you new. It'd be a zero amount we'd be pulling in. New means that you haven't had a cost report. In fact, let me see if it's not too far away. So I'll just give you this example and then I'll jump back there. So right now for federal fiscal year 26, which is just about to start, the uncompensated care payment is based on data from your cost report period beginning in federal fiscal year 2020, 21, and 22. So let's say you started in 2023. You don't have any of that data. So you're considered a new hospital until basically until the next year, because then your 2023 would be gathered. So if you have a cost report period beginning at least in this latest year, maybe you didn't have the first 2 years, but as long as you have one of these 3 years, even if it's zero, then you're not a new hospital, and we can use the data from these 3 years to calculate your uncompensated care payment. So hopefully that helps to clarify. It's not just newly DISH qualifying. It's, do you even have a cost report at all in one of these 3 fiscal years? Which we'll come back to that in a minute and hopefully clarify that a little bit more. But what I wanted to do now is show you, in fact, I'm going to actually open up the whole thing rather than this screenshot. The UCP factor 3 that is used to calculate your payment is found on the CMS website under each year's final rule and in this file called Medicare DISH Supplemental Data File. So let's bring up the whole thing here. Let's actually start at the beginning. This is the CMS.gov website. Of course, we need to go to Medicare, and we're going to go to payment, and we're talking about the prospective payment systems. And then if you go down, you see all the different types of PPS providers. Of course, we want acute for this situation. And then there's a lot of good topics here. Like for your SSI ratios, you'll find them in the DISH section. You can find some GME stuff. But if you scroll all the way down, that's where you'll find the final rule tables. Now, briefly, I'll say historically, when the Federal Registers came out each year, a long time ago, they were completely on paper. Then they moved to PDF. And in those situations, the tables used to be just printed, whether it be hard copy or PDF. They were exhibits to the printed document. So you could always find them just by going to the Federal Register. And, that's nice, but you can't really do a whole lot of analysis with a PDF. It's much more difficult. So several years ago, they started to report or post their tables to the website. So if you go to this 2026 IPPS final rule homepage, you're going to see a lot of information. Here are the links to those files. This impact file and supporting data files, that's where you're going to find a lot, but you also have the tables here. And if you scroll down a bit, that's where you'll see that Medicare DISH supplemental data file. And you'll find a lot of other stuff, but this is what we're talking about specifically. I guess first thing I want to talk about is these three different, I'm using 2025 on purpose, by the way, last year, because I wanted to show you that there are different iterations of the file. Right away, for example, in August of this year, they reported the final rule, and they had this tab. Of course, it would have been for 2026. Often they come out with a correction notice when they have some more data or they've had some public comment about some of the data that existed. So here's a correction notice. It's the same information, just some of the things might be tweaked. Then they might have an interim final rule with comment after that, and that's the latest version you'd want to use. So that's what we're going to be using here. But what I want to stress here, and by the way, this is all providers. I just blacked out the provider numbers. They're still public. It's not a big deal, but I just blacked them out. So this gives you the break. CMS did all the calculation and then they just plugged the number in. So unless you really research this, it's not as transparent how they came up with this number. So we're going to walk through that here today. This file layout tab becomes very important because it gives you some of the data elements that are needed for that calculation. So it describes all those different columns, but here are the pieces that are extremely important. It gives you, and remember we had a final rule, a correction notice, and an IFC. The IFC is what we're looking at here. So it gives you that, what they call the factor 3 denominator for those 3 years that are in question, 19, 20, and 21. This denominator is basically the sum of all hospitals S10 line 30, because that's going to be the denominator for every individual hospital's share. In other words, it's provider A's S10 line 30 divided by all providers S10 line 30. That's how you calculate their factor 3 share. But it's not just a 1 year amount anymore. It's a 3-year average. But the way they've averaged it, again, itself isn't all that transparent. So we're going to talk about that. But there's one more element that's easy to miss if you're not aware that it exists even. There's something called a scaling factor, and you can see it's 0.99875,398 for this year. I think it defines the scaling factor right here. It exists so that all three of those factor 3s can be equal to 1.0 as a whole. So that's just a mathematical way they've done it. And just remember the scaling factor. We'll see it in just a bit here. So before we go into the calculation itself, I just want to briefly talk about a few of these things. This column B, projected to receive DISH in federal fiscal year 2025, you could have yes, no, or even SCH. SCH, basically that means they may or may not get any benefit from the uncompensated care. But let's say it's no. So it's no, and that basically means they're not going to get any interim payments along the way per discharge, claim by claim, because CMS doesn't believe they're going to qualify. Of course, that could very well change. You might qualify at final settlement, and now you're going to get your entire lump sum at the time of final settlement. If you did qualify throughout the year, then you'd see an actual per claim amount that you'd be getting on an interim basis. But notice in both cases, whether it was yes or no, you still have this data. So you can still calculate and the factor 3 itself was calculated. There's a couple other things. IHS or Puerto Rico, they're handled a little bit differently. Rural community hospital, but this new hospital. So we just said that if it's a new hospital, it may not have all of that data or may not have any of it for that matter. So let's say, yes, it's new. They don't have any data to even calculate a factor 3. And that means certainly you can't get an interim payment, But the question is, what happens at the time of final settlement? You're a new hospital, and we need something to calculate a factor 3. And the answer to that something we'll see on the slide in just a bit. You get to use your current year S10 data divided by the most recently available denominator. In other words, in this case, it would have been the 22, whatever that most recently audited year was. That's your denominator for your individual factor 3, and your numerator is your current year S10 line 30. So that's the odd situation where there's not a 3-year average. While you're a new hospital and you don't have any of those 3 years that are supposed to be used, you get to use the current year in question, pull that line 30 data, divide it by the most recent denominator that's available. That's your individual factor 3 for that year. So we'll come back to that in just a bit, but I wanted to show why that's reporting that way. But even if you're not a new hospital, there could easily be a situation where you don't have all of the years. You have some of the years, but you don't have all of them. Now, a couple things here. First of all, these first providers don't have any of the years, but it's zero. It's not blank like it was before. It's zero. That just means that S10 line 30 was zero for them. It's not a new hospital. They just don't have any charity care to calculate a factor 3, so they're not going to receive a factor or a uncompensated care payment. But other providers, they might just be missing 1 or 2 years, but they have one of the years. So a factor 3 would be calculated based on what they do have. For this provider, it would have been a 2-year average instead of a 3-year average. And there might even be some that have just 1 year. Like this one right here just has 1 year. As long as you have at least one of these 3 years, you're not considered new, and you get a factor 3 calculated on whatever you do have for whichever these years you do have. But if you don't have anything, if it's blank, if you just don't have these years, period, then that's when you get to use your new current year to calculate an individual factor 3. Now, that's generally done at the time of final settlement. Just wanted to mention that. But that's the situation where you would need to fill out, where were we? This line 35 and 35.01. This total uncompensated care amount, that's the entire pool. And then factor 3 is what we calculated for that provider's uncompensated care payment. So I think that's all I needed to talk about for this. Oh, no, I didn't. No, over here. So yeah, I added these columns for some clarity, because when you talk about averaging, that means a few different things. There are a few different ways to average. And especially when you're talking about these 3 years, in order to get this factor 3, let me get off of this filter. So in order to get this factor 3, what CMS did was brought in each of those denominators, which again, the denominator is the same for every provider, but different for every year. That's the sum of everybody's S10 line 30. That's what I just showed you over here. So they brought them in. They took each year's numerator. So for this provider, their 2019 UCC, by the way, it is annualized. So if you have a short period, and then it's the factor 3s that are averaged. So the averaging is done on the very back end. But notice, let's just look at this one. This one was basically 778,664. This average is not quite the same. It's 779,6358. The reason is that you have to multiply that scaling factor by that, and then sure enough, you get 778,664, just like we had over here. So that's the way these are done. they're each year is calculated individually to get a factor 3. Then the 3 factor 3s are averaged, then multiplied by the scaling factor. Now, mathematically, there are a couple ways to do that as well to get the same number, but this is, to me, the most transparent step-by-step way to do it. And so anything you do to come into DISH eligibility would all of a sudden trigger this uncompensated care payment as well. So yeah, you might not qualify at final settlement, but then perhaps during a reopening, you now have a higher SSI ratio through a realignment. If you qualify for DISH, we would also have to calculate factor 3 at that point in time for you under the same methodology. So very good question. So hopefully that clarifies what's going on with the uncompensated care payment. It's just one of those really convoluted things that's been out there for a long time, but it's so just convoluted, I guess, not really a better term for it. But that'll be done by the auditor. Again, if you know the numbers, if you could calculate these at the time of submission and do the same thing, if you know you're a new hospital and you know what your line 30 is, you could calculate them at that time, and then we'll verify it at the time of final settlement. So that's what we have there. And yeah, we covered all of this. So we said it's an average, again, of 3 years, and it's been that way for a while. We expect it'll continue on for the foreseeable future. But keep in mind, these are all federal fiscal years. And the way DISH works entirely, whether you're talking uncompensated care or SSI ratio, it's all about the cost reporting period that begins in that federal fiscal year. Same thing with S10 in general. It's always the fiscal year begin, and it has to fall in that specific 10/1 to 9/30 federal fiscal year. So if you are a new hospital, we're going to use the cost reporting data for your current year in question divided by the most recently audited factor 3, which is available till at a minimum, well, the final rule will be August of next year. So we have that. Now there's also a newly merged hospital, which I need to bring the template up one more time. If you have hospitals that are merged, then if CMS knows about it by the time of the final rule, there's actually a table or tab called mergers that basically shows you all this data. It shows you the data from the surviving hospital and the provider number prior to the acquisition, and it brings all that cost report data in. Again, these are public files, so anybody can go to the CMS website and find this. But it shows what year it was in question, and more importantly, it shows the factor 3 data, from the S10, basically from S10 of all the providers. Three components for the surviving hospital, and then the factor 3 components of the acquired hospital. And then it gives you the combined data that can be used to calculate that factor 3. So that's if they knew about the merger and they had all of the data by the time they did this final rule. But if they didn't, if the merger took place too late where they don't know about this data, it's treated the same way as a new hospital, where we get to use that data from the current cost report and divide it by the denominator to basically recreate your factor 3. Obviously, it gets much more convoluted or more, I guess, tedious as well when we have to do this on the back end, because you're talking about multiple hospitals, but all the data comes from that S10 line 30. So if you ever have any questions about this, you can certainly send those in. So that was the big topic there for the Factor 3. Let me see if there are any other questions. Looks like the chat area is working well today, so it didn't lock up on me. I guess I'll just have to use the app from now on as opposed to the browser version. So change request 13413. Now we're talking about SSI realignments. And I do want to stress here that SSI realignments themselves have been around for since almost the beginning of DISH. There were a couple of years where at the beginning where realignments were not allowed yet, but they've been around for almost as long as DISH. But there have been recent changes through this CR 13413 that have now clarified a couple things and also created this big project where CMS, for anything fiscal year begins prior to 10/1/13, CMS actually published all of the realigned SSI ratios. Whereas in the past, you had to either do the work yourself to get an estimate to know whether you wanted to apply or not, whether you wanted to realign. And then when you submit the request to the MAC had to go to CMS to get the formal calculation. Now that process is still in place for anything 10/1/13 and after. We still have to go to CMS to get those. They are not published for the later years. So all of that's unchanged. This change request was for years 10/1/13 and prior, where again, you can see the SSI ratio that's being used or that's going to be used, and you can compare it to the standard SSI ratio that wasn't realigned, and then make a determination whether you would like to realign. This link takes you to that CR as well as the information on the ratios. This CR was effective 7/31 of 2024, so we're a little bit past the 1 year mark with that. And what I want to stress here, though, and we've tried to clarify it a few times, that if you had an SSI realignment request prior to 7/31 of 2024, because a lot of those were on hold as CMS was going through this, any older realignment is essentially, I don't want to say null and void, it's still there, but we cannot do any work on it at all until you confirm that you want to move forward with it. CMS wanted to make sure that now that you can see the SSI ratios, that you still want to proceed. So we've worked with our providers and sent out emails for anybody that did qualify in the past. We want to make sure that A, you either want to continue on, or B, maybe you decided you do not want to continue anymore, and we can close that realignment request down. We just don't want them hanging out there with, no direction to go at that point. So these are all due within 24 months of the receipt of the provider's SSI realignment request, revised SSI realignment request, or confirmation, if you will, or it could be a brand new request if you never requested anything in the past. But there is one exception where some of these, well, I shouldn't say one exception, there are a few situations where we need to go to CMS, even for these older years, and get their permission to continue forward. One of them is an easy example where where if CMS published a year that apparently was incorrect, it doesn't match what the provider submitted. The year is just a different year, different months, whatever. It's not the same period. So we have to basically get CMS to republish the right ratio for that specific year. And there are a couple of other scenarios in the change request where CMS wants us to forward it on to them for permission. In that situation, the time frame starts when we get their approval rather than when we got your request. Now, the thing is, again, this goes all the way back to 10/1/1987. It's not the very beginning of DISH, but it's pretty darn close. And the thing is, there's no time frame anymore for submitting, and I shouldn't even call these reopening requests, they're realignment requests. That's the reason there's no time frame. Realignments are separate in the regulations from reopenings. It's a different mechanism altogether. So That's why CMS allows us to go back all the way to 1987, or allows a provider to go back there and submit a request. It's referred to as a revised settlement as opposed to a reopening. And all this stuff is stuff we've talked about in the past. We've got a change request article on our website. There's a YouTube video talking about it, but I just wanted to refresh on it to make sure everybody's still aware of it. Now, of course, the challenge here and the reason that this 24-month period even exists rather than something shorter is that, first of all, we have a large bulk all up front, all at once. But even more importantly, we're talking about very old cost reports that are not likely to be in electronic format. Obviously, until you get to the 96 format, nothing will even work in an electronic format. So we have to order up hard copy files. We have to find the right settlement. We have to reconcile the settlement. We have to clear any level 1 edits that might have been generated by the system since that last settlement. So there's a lot of kind of overhead type work related to that, as opposed to just straightforward doing the dish calculation. So all of that is kind of messy. We're working on these, and basically the earlier you can get your request in, the better, because we can at least start doing that research, gathering that data. Now, there was one point, real quickly, the only thing you need to submit for a realignment request, this is detailed in the CR. It must obviously contain a sentence or two that, hey, I want to request a realignment, but it has to have the provider number, fiscal year begin, and fiscal year end. That's all that's required. You can send in a letter, you can send in an email, either way works. And it can also be a mass submission. It could be 10, 20 providers in the same email, as long as they each have these 3 elements. The one thing I also want to mention again, if you're trying to cancel a prior realignment request, you don't want to confirm it, then you can send the email in just saying, please cancel this, or we rescind our original request from prior to July of last year. Whatever works. Let's see, we talked about the due date. And the other thing I mentioned last time, we know some providers at a time were holding on to their SSI realignment requests while they were awaiting the Supreme Court decision on SSI eligibility. That was decided in April of this year, and there are no changes now. CMS won that case. So there's no other obstacle for sending this in, basically. Let's see, what year is that? Was that when you were talking about the 10/1/1987? That's when realignments came into play. 1985 is when the dish started, but 87 is when the realignments came into play. So hopefully that helps to clarify. Oh, what year is the ratios incorrect? Not sure what that was relating to. What were the ratios incorrect? I'm sorry. Yeah, that's anything 10/1/13 and prior. No, I see what you're saying. No, let's say you have a let's say that's your year, but for some reason CMS had bad data and they thought you had an 8/1 through 7/31 year instead. So they published 8/1 through 7/31, but that's not your year. Then in that situation, we need to go to CMS and say, hey, we think you have the wrong year. We can look on our system and prove it to them, and they have to recalculate the ratio for the proper year. So yeah, that's where the permission comes into play. It's not really permission per se. It's they just need to recalculate it. Yep. Yeah. Good question. Okay. So that takes us through realignments. So again, you could submit them to this email address for WPS, of course. And now we'll move on to the topic of RHCs. Now, this is one we covered in quite a bit of detail last time, so I'm not going to go through as much detail. I've got the information here. That could potentially increase your total visit count up to a floor. Higher total visits in this calculation would lead to a lower cost per visit rate because they're spread out over more visits. And even though it was discontinued for 1/1/25 fiscal year ends and after, it was still in place for the base rates that we're going to talk about a little bit later. That's the critical piece here. Now, M-3 is where, well, we're going to see the next few slides where all of this is reported. Worksheet S-8 has two control questions that are relevant here. Line 12 talks about whether or not you've received an exception to the productivity standard to avoid having your visits increased to that floor. And line 13 asks about whether you've consolidated. Now, in this case, they haven't consolidated, so there's no detail below it needed. If they did consolidate, they'd have to report how many provider numbers, how many RHCs have they been consolidating into this one cost report. And then down below, you'd have the detail of what RHCs those were. M-2, this is where, first of all, you have the number of FTEs for each type of physician or mid-level practitioner. You have to report their actual total visits from your records. And then there's a productivity standard. This is a per FTE productivity standard, by the way. The total visits it's just your total visits for all the FTEs you've had. But this productivity standard is just for one FTE as opposed to the 1.88. And normally, the physician productivity standard would be 4,200 and everything else would be 2,100. So the fact that this is 750 tells us they must have been approved, or hopefully they've been approved for a productivity standard exception. And that means you've been approved for a lower exception or lower standard due to a variety of things. Even during the COVID years, it was more lenient than before even. Now, what would happen here is this productivity standard, which is a per FTE standard, would be multiplied by the number of FTEs to give you a new minimum number of visits. Now, in this case, the productivity standard exception didn't help them because they were still below that total visits. And now everything is going to be bumped up to this visit count. So now we're using 1410. We're using a higher number of visits, which will decrease the rate, the cost per visit. That 1410 is brought over here to M-3. Cost per visit, which itself could be subjected to a limit and was historically, with plenty of exceptions there. Line 8 is where the limit is reported. And then if you were subject to the limit, then that limit would be brought down, whichever, assuming the limit was lower, that would be brought down here to your allowable amount. But in this case, the actual cost, even though it was much higher than the limit, the actual cost is coming down because this provider was exempt from the cost per visit limit. And generally that's because they were associated with a hospital that had less than 50 beds, but there are other ways you can be exempt from that limit. Again, we are talking about pre-2021 rules here, where we had the old limits. And then, of course, that's multiplied by the number of visits to get your allowable RHC cost. And we talked about the exception here. All of that's the same. Now, there are alternative ways, or there were alternative ways to be exempted from that limit other than being associated with a hospital with fewer than 50 beds. It involved a couple pieces. First of all, you had to have an average patient daily census count of 40 or less. That proves that you're small. But also you had to have certain RUCA codes. Rural urban commuting area is what that stands for. And a couple of them different ranges of RUCA codes qualified you for that. There's a article out here that goes into detail on that. But again, that's the old standard. Now we're gonna talk about a couple topics building up to the new rules and the new and just provide the detail, just show what provider numbers were consolidated, and then all the data is going to be on one line number of worksheet A. It's going to have one worksheet S-8 report and one M series. It just it simplifies the documentation. That's what it boils down to. There could be some benefit for how the cost averages out as well. There are other reasons to do it, but CMS does allow it. For cost reporting, you still have to bill the claims separately under their individual provider numbers. Very similar to the whole DISH Medicaid day counting, the rule is simply that you have to notify us or elect it in advance of the cost reporting period. If you want to deconsolidate, you have to elect that as well. This is the policy change where CMS attempted to clarify how this has changed now that we have the new RHCs versus the old RHCs. So what I want to say about that is on or after 1/1/21, any new RHC that was enrolled on or after that date is going to be paid different, potentially, well, they will be paid differently than the older RHCs. The rules changed 1/1/21. Now, this is all about the consolidation requirement, and I'm going to come back to this in a bit, but what CMS did here, they tried to clarify how you could consolidate. Prior to this change, consolidation was all or nothing. You either consolidate every single RHC into one, or you can't consolidate any of them. They'll each have to be reported separately. This is where CMS changed that, and they basically said what we're going to see is you can now have two and only two groups of consolidation. In other words, no more than two. That's the clarification from CMS. We're going to see that you have the new RHCs or the non-grandfathered RHCs versus what we call the grandfathered RHCs, which I'll define in just a minute here. Yeah, we talked about, this is worksheet A. It's line 88 and subscripts. That's where you report the total cost of the RHC. S-8 is where, we already talked about that. You'd report that you were consolidated. And then we talked about M1 through M3. M1 is basically worksheet A. It just breaks out that one line number on worksheet A into all this detail for that RHC. All these different cost centers. You still have reclasses and adjustments. The total down here must tie to worksheet A, that one line number. Now, here's where the rule changed. This piece of legislation here back in December of 2020, they said any new RHC that was established on or after 1/1/21, as well as any RHC that had not previously been exempted from the cost per visit limit, they're now going to have a new payment limit. It's not going to be the normal annual limit they had before. It's still annual, but it's a different limit altogether. They started 2021 with $100 per visit, and they've inflated it forward through 2028 right now. Now, any provider that was grandfathered in the past, in other words, they were previously exempt from the per visit limit, they're now going to have a new limit that's based on their own cost report from a base year, similar to how we have SCH and MDH hospital specific payments based on a base year. It's the same concept. So 1/1/21 was the cutoff point for new versus old. However, none of these rate changes took place until April of 2021. But again, 1/1/21 was the cutoff point. The grandfathered facilities, well, let me back up. The new or non-grandfathered RHCs are obviously the very new ones, established 1/1/21 or after, or any of those that had not previously been exempt from the limits in the past. They existed before 1/1/21, but they were not exempted. If you're grandfathered, that means you existed, that RHC existed, and it was in a hospital with less than 50 beds, and they have to continue to meet that requirement. Otherwise, all of a sudden, you're going to lose your grandfathered status and revert to the national rates. So that's the important thing. If you were less than 50 beds, you need to make sure you're less than 50 beds from here on out to keep this beneficial treatment. Now, again, we have these preset limits for the other RHCs, the newer ones, the non-grandfathered. This just is a new cost per visit limit. It's going to go right on. Well, I guess we talked about it before where we had the limit reported. It's the same mechanism. This is just the new limit. For the new RH, or I'm sorry, the grandfathered RHCs, we calculate a base year limit, and then that gets inflated forward each year. And then the mechanism is still the same. Whatever your actual costs for that year were, they're just subject to this limit. It's for the RHCs that previously existed, and they existed in 2020. They had a full calendar year 2020 cost report, or they had a full that limit fall below the national limit. If it does, you're going to be brought up to the national limit. They're not going to penalize you for being a grandfathered facility. So that's how we calculate it if you had a full 12-month cost reporting period. If you didn't have a cost reporting period in 2020, then we get to move forward to 2021 to see if you have a calendar year, a 12-month cost report period then. Now, keep in mind, you did have to exist as of 12/31/20. I'm sorry, yeah, you have to exist as of 12/31/20, but you might not have had a full year, or you might not have had costs. You might not have started providing service. You did exist, though. Now, technically speaking, since it has to be a 12-month cost reporting period, you might have a couple or 3 years of short period cost reports. So it might, the base year could be 21, 22. CMS, which if we go down to this rule about consolidation, initially in the proposed 2022 rule, they said for simplicity, we're just simply not going to allow RHCs to file consolidated cost reports. In the final rule, they said, okay, we'll allow it, but the two different types of groups can't consolidate together. They have to be consolidated into their own type of group. In other words, grandfathered facilities can consolidate with other grandfathered facilities, and newer or non-grandfathered RHCs can consolidate with those. There have to be two separate consolidated groups. We initially thought, well, there could technically be more than two, because CMS did stress that you cannot consolidate different base rate years together. If you have a grandfathered facility that uses 2020 and then a couple that use 2021, you cannot consolidate those together. You have to keep them separate. But we thought initially that each type could have its own consolidated group. A grandfather 2020 group, grandfather 2021 group, maybe a 22 group, a new group. CMS just recently clarified, no, it can only be 2, and specifically it can only be the 2020 grandfathered and new or non-grandfathered facilities. If you happen to have any RHCs with 2021 or 2022 or whatever base years, those simply cannot be consolidated at all. They have to be reported separately. You might still have your other 2 consolidated groups, but then these other ones would have to be individually reported. I honestly was very surprised about that response. I thought we'd be able to have 3 or 4 consolidated groups, but CMS shut that down just because of the way it was worded in the Federal Register, where they talked about 2 specifically, and they referenced 2020 specifically there. Now, so this is how it would look, grandfathered, non-grandfathered, and you might even see some 88.02, 0.03, 0.04 for individual RHCs that had 2021 or later base years. So I want to talk about some of these edits, some additional edits. This, again, the word serious, I don't know why they chose to use that for a label, because it's not really that serious. And in some cases, it's something you need to ignore, like this one right here. On S8, line 13, if column 1 is answered yes, that, hey, we can, this comes back from the day when it was all or nothing, and that's simply not the case anymore. So this edit needs to be removed eventually. You can ignore this serious edit. But this one does need to be fixed. If you have column 1, line 13 is no, in other words, we're not consolidating, then line 13, column 2 must be blank, because that's the number of units you are consolidating, which of course makes no sense if you're not consolidating. And line 14 and any subscripts, which is where you report the units that you have consolidated, those must be blank. And that makes perfect sense there. If you're not consolidating, none of this stuff right here should exist. You should have 0 here, and these should be completely blank. They wouldn't even show up. But if you answer yes here, then you need to report a number of units you're consolidating, and that gives you a number of lines to report which units you're consolidating. Now, the other answer from CMS, this was the last clarification that we talked about last time. The base year calculation, the rate itself, once it's set, once you've consolidated and the rate is set, you can no longer change the consolidation. You can't recalculate it just because an RHC is terminated, and you can't all of a sudden decide to consolidate if you hadn't already made that decision. So that's the other clarification CMS made at that point, that once the rates are set, short of a mistake, which is what we're going to see right here, because now that CMS had more clarification, if we did try to allow the 2021s and 22s to consolidate, we now have to separate them out based on CMS clarification. So other than an error like that, or amended data, like if you have an amended cost report with new costs, new visits, whatever, those things can lead to a rate change. But a change in the consolidated group just due to a decision to deconsolidate or whatever, that cannot lead to a rate change. Once you've consolidated, you're locked in for that rate at least. And that's what CMS said there. We already talked about this. Talked about the productivity standard being discontinued. And that takes us through the end of RHCs. A lot of information there. And that is one, now that we have our final clarification, I'm going to be updating our website and probably now putting a YouTube video out there on all of this RHC information. So we'll have that resource and we'll let you know about that as well. Just briefly, I wanted to go through the 2026 IPPS final rule. I'm not going to spend much time because I definitely want to get to the bad debts. But this is the link. We already talked about the web page where you find it on the CMS website. Here's that same thing. We already talked about the tables. That's where you'll find the standard updates like the new wage indexes, like the new cost to charge ratios, all of that you'll find right there, as well as the uncompensated care status, all of that. A couple of changes CMS made. Obviously, any federal register is a big one, but we tend to focus on the things that had an impact on cost report or claims for our side at least. There was one change that CMS made where they used to have for a little while they had a low wage index hospital policy, and that was to help some hospitals that were in areas that had very, very low wage indexes. Now, the problem with wage index is that if you do anything to increase one area's wage index, that takes away from the other area's wage index because it's going to be I guess you could call it a zero-sum game, if you will, that they all have to, one affects the other. Let's just put it that way. So this little policy they had in place was always intended to be temporary, but there were appeals on the issue because of the fact that it impacted other providers' wage indexes. And this DC Circuit Court decision shortened its life. So now CMS is phasing it out much more quickly than planned, but there's still a limit. They're not going to have providers be harmed in a great amount by all of a sudden dropping that down to the absolute low wage index. Any decrease is limited to 90, going down to 95% of the prior year. So it is a phase out. There's just a very brief change to the EHR incentive, what's now called the Medicare Promoting Interoperability Program. And it's the period of time that you have to attest to meaningful use throughout the year. It used to be a 90-day minimum for that calendar year. Now it's 180-day. Nothing really too drastic there. Two big changes that hopefully we kind of expect that Congress might extend these, but the MDH program technically terminates in a week unless Congress extends it. The low volume hospital payment, it doesn't terminate per se, but it goes back to the old qualification factors that very few providers nationally qualified for unless Congress extends it. So I call these the lenient qualification factors. They've been in place for a number of years now. You have to be more than 15 road miles from the nearest hospital, so you can be fairly close to them, and you have to have less than 3,800 total discharges. Right now, 579 hospitals qualify nationally, but when the old qualification factors come in, that'll drop significantly to less than 55. And we don't know the exact number because the only data we have we have the discharge data to find out how many have less than 200 total discharges, but we don't know how many have more than 25 road miles compared to more than 15 road miles. So it's probably going to be significantly fewer than 55 if they do indeed go back to the old factors. This has happened before. This is not the first time these have temporarily been discontinued. So far, every time Congress has come back and extended it, and of course CMS has to process that as well, implement it, if you will, through a change request in the Federal Register. But the point is, it's always a mess when Congress doesn't do this until after 10/1, because then we've shut providers out of this. We have to turn them back on. We have to reprocess claims. The other thing about this for the low volume is that there's that annual attestation requirement. The normal due date for that is 9/1 of every year, but obviously this year it's technically terminating, so that there is no due date yet. When this gets, or if this gets extended, CMS will give us a new due date. But what we've been telling providers up to this point is if you want to submit your attestation now under the hopes that Congress will extend this, you can certainly do that. But there's a little caveat to that. If you submit it now, we have to use the total discharges as of the date of your submission. So that doesn't automatically get updated to a newer cost report that might come in the next month or two. However, if let's say Congress extends this, let's just say it's 5 months down the road before Congress extends this, hopefully not. But if it's 5 months, then a lot of providers are going to have a new cost report. At that point, you would have a new window if you wanted to submit a new attestation and a new discharge count. You certainly could at that point. So if you want to submit them now just to get it out of the way and make sure you don't miss a due date, you can. You'll also have another opportunity whenever CMS opens up the window. So you won't have to do it a second time, but you have the ability to do it a second time. Now we'll move on to the topic that I wanted to spend some time on because we've had a fair number of questions about bad debts in the past couple months, 2 or 3 months. First of all, Medicare versus total bad debts being S-10 line 26. It's all about a difference of when the bad debt is reported. For S10 line 26, it's only based on when it was written off for GAAP reporting purposes. We know that Medicare has some additional rules that have to be met, and sometimes that extends past the write-off date, the GAAP write-off date. For example, collection effort has to have ceased. It has to be returned from the collection agency. Sometimes that puts you in a later period than when the original GAAP write-off took place. The other thing I want to clarify again, I try to take every chance to clarify this. When they throw out the word expense, that's not a write-off. Bad debt expense is your earlier estimated entry based on all of your patients, all of your customers, so to speak. The write-off is patient specific, and that's at a later time when you know that particular patient is not going to pay. Expense was erroneously used in the cost reporting instructions before, at least the label, but now they've clarified it. I also want to throw out another topic that's going to lead to something in just a bit. Expense is not even a proper term under GAAP anymore at all for bad debts. It's now ASC 606 basically changed how bad debts are handled, and it's no longer estimated and charged to an expense account. Instead, it's estimated and charged to a contra revenue account, directly offsetting revenue instead of waiting till later in the income statement to be reported as expenses. Now, the contra revenue account is referred to as implicit price concession. There might be some other names for it, but that's the one that's used in Medicare policies. But I want to stress that can't be confused with contractual allowance. Yes, they both start with contra, and contractual allowances themselves are a contra revenue account, but this contra revenue account is not one that's allowable for bad debt. CMS has been very clear about that. If it's written off to a contractual allowance, that tells us the patient never had a liability for that amount to begin with, and we'll see some repetition of that in the next couple slides. So the point is, if it's written off to a contractual allowance, it's not going to be allowed as bad debt for Medicare or total. It's just an offset to revenue, no different than sales discounts, sales returns, things like that. So again, all bad debts must stem from patient liabilities, and the patient liability was waived in a contractual allowance situation by contract. There was a MedLearn Matters article back in 2019 on that particular topic, and they said do not write off to a contractual allowance account. At the time, they said charge to an expense account. We know that's changed under GAAP, but they did stress that beginning on or after 10/1/19, this must be in place. And CMS has been very clear about that. I want to stress, though, the thing that changed was the bad debt expense versus contra revenue. There was a timing difference between when GAAP changed kind of got fortunate. It's, I guess it's hard to say fortunate, but COVID extended the period or the deadline for when non-publicly traded companies had to follow this change. They extended it, and fortunately, they extended it to past the point where Medicare finally took it into play. So really, this whole I'm calling that kind of a gap period. The difference when GAAP required when GAAP required contra revenue accounts versus when Medicare even allowed it, that gap only applies to publicly traded companies. Any non-publicly traded company, you're kind of in luck because the time frames match up. You can use the contra revenue account. But again, it can't be a contractual allowance. CMS has stressed to us multiple times that that's the case. And the IRS has now even stressed that as well. It impacts tax differently than Medicare, obviously, but they issued a directive on contractual allowance issues for bad debts. Here's a little link to a summary of that directive. And the quote from that is, contractual allowance does not constitute bad debt since the provider was never entitled to collect the difference under the terms of the relevant contract. Therefore, there's nothing to write off as bad debt. There was never a patient liability to begin with. This just talks about, the whole written off and their balances owed by patients. I mentioned on S10, line 26, they used to have, it annoyed the heck out of me because it was wrong from the very beginning, but they used the total bad debt expense label. It was clear in the instructions that it had to be a write-off. The next topic is one that again has come up recently. It's been a while since we've had to deal with this. It's all about the indigent bad debt asset test requirement specifically. This has been appealed multiple times, and it's all about the use of the word should in the policy versus a stronger must. And the CMS has required it. So regardless of what you think of the word should, CMS's intent was that was an absolute requirement. Now this applies to prior years, prior to the 10-1-20 or the prior to 10-1-20, as well as prospectively. The difference, though, is the level of authority that backs it. CMS codified a lot of their bad debt policies into regulation in the federal fiscal year 2021 final rule. And one of them that they codified was this indigent requirement. They go through this lengthy explanation of all the comments they looked at, and they stuck to their guns and they said, we believe that evaluating a beneficiary's income and assets is more appropriate. And then they talked about how they also at the time were using liabilities and expenses, which is obviously the opposite side. Then here's an important point. They said, finally, we have reviewed the federal court decisions that many commenters cited, but they do not agree that they prevent CMS from adopting the rules regarding total resources, income, and assets that they're finalizing. So they very clearly addressed the fact that, yes, they did lose some cases on this issue, but none of them were to the level of legal precedent. In other words, it wasn't the Supreme Court. It wasn't the DC District Court of Appeals. It was always at the kind of the trial court level, the initial court level, which don't carry a formal legal precedent. The point is CMS is sticking to their guns with this. Prospectively, it now carries the force of regulation. When CMS was initially finalizing this or proposing it, they planned on making the entire change both retroactive and prospective because they felt it was just a clarification of existing policy. However, in the final rule, they decided to make a change to remove liabilities and expenses, having nothing to do with assets, but they removed liabilities and expenses, making it a little easier for you to just less documentation that served no purpose. Since it was a change, they could no longer make it retroactive. So basically, this regulation is applicable prospectively, and prior to 10.120, it's just policy that CMS has very strongly defended. That doesn't mean something might not change in the future due to other appeals, but right now we've been told very strongly that asset test is required for any and all years. For the later years, we don't have to worry about liability and expense. That's a lesser concern anyways. The next topic we have for indigent patients' bad debts is a timely determination, or potentially billing if you haven't made a timely determination. So this is still in policy. CMS didn't even address this, unfortunately, in the regulation, but Section 310 of the CMS publication 15-1, it discusses how in some cases the provider may have established before discharge or within a reasonable time before the current admission that the beneficiary is indigent. Before discharge is a perfect situation. It's sometime during this stay, but before they discharged, you've evaluated their resources and you've determined them to be indigent. But they're saying you could also use a prior determination from a prior admission as long as it's not too old and it's still relevant. But notice that there's nothing technically saying you can allow a determination that was made after this current discharge. That would technically be too late, but it's not clear enough. It's just somewhat ambiguous. So that's why we've been able to allow a grace period if it's made a little bit after the discharge, but not too far after. And the time frame that's been established, if you will, is the normal timely billing time frame from a non-indigent bad debt. Basically, the thought is it's a grace period that technically doesn't even need to be allowed based on this policy, but it has been allowed for years. As long as you establish indigence before you would have normally had to start collection effort of a non-indigent patient, then we can allow it. But if it's past that point, if you still haven't established indigence, you're required to engage in collection effort, including the timely billing requirement. So the easy way to fix that is to establish the indigence sooner, and then there's never any collection effort to worry about. But this is something that's come up. This actually came up a few years back, but the questions have come up again this year. So we wanted to reiterate that. One last item that is not in your slides, but I wanted to cover, it's another topic that's come up from CMS. They want to make sure we're handling bad debt recoveries properly. So just as a reminder, a bad debt recovery, it's when you didn't think you were going to collect against the patient and you wrote it off, but then sometime down the road, they come back and pay something. The year that they pay it, it's going to be offset against that year's bad debts. We're not going back and reopening earlier years to kind of correct things. It's going to be written off against current year bad debts. So what we need to know is how many recoveries did you have? CMS requires us to look at the trial balance, the working trial balance, and try to identify if there's any risk of recoveries that may not have been reported, charged off against Medicare or reversed against Medicare. In some cases, we've seen providers that have very clear separate accounts for Medicare recoveries and non-Medicare recoveries. In that case, that's perfect. But in other cases, we've seen situations where they might have just one bad debt recovery account with no real indication of how much of that was Medicare and how much was non-Medicare. So in those situations, we would be asking questions like, how do you determine how much of those are Medicare versus non? And in some cases, depending on the scope of the review, we might need to request a listing of all the recoveries to make up that total and sample some of them to determine Medicare eligibility or not. So we know we can get assurance that the recoveries have either not existed or they've been properly offset. Again, this just depends on the scoping. We're not saying every single unit has to go through this, but we need some way of knowing that you've offset recoveries. That's what it boils down to. And then we're down to about 5 minutes. I just wanted to spend a couple minutes on this nursing allied health managed care add-on calculation. It's something we covered in great detail back when we had a project going on around 2024. Fortunately, the newer years are much less convoluted. The older years, there was a lot of complexity to it. We have this website article that includes our nursing and allied health add-on payment calculation. It's an Excel spreadsheet. Remember those old projects we worked on, we finished them up March of 2024. They only impacted 2010 through 2019 calendar years. Anything after that is the more simple calculation. Keep in mind, though, the payment is by calendar year. So again, you might need two calculations if your cost reporting period spans 2 calendar years. The one thing I want to point out, which I guess we'll see it in the template when I bring it up in a second, the first thing you need to know, which is one of the more confusing things based on how it was worded, you need to make sure you're grabbing the proper prior cost reporting period to calculate the allowable nursing allied health for this current year. The rule, the regulation says, and this is not a direct quote, but it says it's the cost report period that ends during the federal fiscal year that is 2 years prior to the calendar year in question. Somebody had a lot of fun developing that requirement, making that as complex as possible. The word is here. They're basically saying whatever the last digit of that year, that federal fiscal year is, look for the same calendar year. That's the easy way to describe that. In our template, we've tried to make it abundantly clear and step you through that. So when you go to the input tab, you enter your current year information. Then in order for this template to help you identify the proper year, it basically says just type in the fiscal year begin and end for your past 6 years. That should give it enough of a range to look at. And it'll tell you specifically which one of those years would be needed, or which two potentially would be needed for your current cost reporting period. So right off the bat, you'll know which ones to use. And then now you start entering cost report data. And all these blue cells are already, their formulas are populated, but the yellow cells are what you actually enter for the cost reporting data. Keep in mind, you might need both of these columns if you're not a calendar year cost report. There's a tab for each of the calendar years. And again, a lot of that, by this point, all that stuff's carried over because you've already entered it on the input tab. This is just the transparency of the calculation. Now, we have update factors in this last tab. They've currently only been updated in 2024 because the audited cost reports aren't available yet for CMS to update it further. By August of next year, we expect that the 2025 factors will be available. We know you're filing cost reports with 2025 already, many of you, and the only thing we can do is use the last factors that were available until final settlement, basically. So all the factors are here with references to where you can find them, and those all get brought into these calculations. So that should help you to know what to report on your cost report, and we obviously will review it at final settlement as well to make sure it's correct or changed as needed. By the way, this little cell is no longer needed because that was just for the project. But if you do enter yes, then all these references change. So just make sure that's blank for the current references. And that takes us, we're down to 1 minute left. So just a summary of the website and the YouTube playlist. We have that. The last, 8 or 9 YouTube videos that we have, including the most recent webinar. Actually, we don't even have that most recent one on there, I guess. Some of this training stuff we talked about last time, I still haven't really gotten back to this. Organ acquisition will probably be the first. A lot of stuff on the list. And then just our webinars. We've had them since October 2020 Today we have September 2025, and we will continue with our S10 ones. Any other questions, you can send them in, but also you be on the lookout for the email that'll come out in a few days with all the other documentation. Just as one final reminder, if you do get the chance to fill out that